Hello, everyone. Welcome to Decoding Markets in 3 moves with none other than Mr. Rohit Srivastava, India's renowned market strategist and the mind behind Indiacharts and Strike.money. So, in each episode, he unpacks the market most pressing questions, simplifies complex trends, and reveals actionable strategies in just 3 clear steps. Whether you are a seasoned trader, curious beginner, tune in to discover how you can trade smarter and stay ahead of the curve. So let's get started to today's episode. So welcome back, sir, to a new episode.
Yeah, pleasure to be back.
So, as we are in the mid of a week, new week, so what are the symptoms and how is the market going?
So I think after a 4-day winning streak on Nifty, 6-day winning streak on Bank Nifty, we have seen the market pull back. And very hurriedly, a lot of people are now arguing that now it's going to crash again. I would like to strongly disagree. Although you can always come up with an argument, and it has happened that the market has fallen several times in the last couple of months, only to end up finding support again and again between 24,400 and 24,500. So this is probably the sixth time that has happened, with only one difference, that by the time the sixth time happened, we are behind with two potential wars, tariffs on possibly tariffs on IT, but not that great, on pharma, but not that great, something in the media sector, and that leaves us with nothing more left to do in terms of bad news. So I would want to believe that 24,400, 500 is where all the bad news got absorbed. And if you're still waiting for it to break, you probably need Donald Trump to send a nuclear bomb onto India. Okay.
Seems so.
So I hope that got people woken up. So if you have not woken up to the idea that India is in a long-term bull market and after every consolidation it will go higher, then the only thing you need to figure out, have we ended this consolidation? I think there are enough signs that we probably have. The government has done enough things that they should. We have entered an earnings season that might not be great, which is a good reason to go short and lose money because the markets are forward looking. I know the last earnings season went badly. July month actually went down, but don't extrapolate. That's my clear cut advice to people. Don't extrapolate just because it happened last time, because the market might this time decide that I want to discount December, because there's everything from a festival season to GST cuts that will play in terms of numbers that will improve in the next quarter. And for that, I have to buy today so that I can sell by December. And the people
Right.
who look at the current data and say that no, it's going to look bad because the data is bad today, are not forward looking. But everything I'm seeing is based on technicals. So that means I have absolutely no idea what the GDP numbers are going to be for the next quarter. So let's understand that when I speak, I'm discounting the fundamentals based on the technicals and not the technicals based on the fundamentals. Because the market, as we say in technicals, knows everything. Because we have studied the wave patterns, which is essentially the psychology and behavior of markets. We have studied the sentiment, which means what everybody is doing and where they are placed. And then we've looked at the trend, what we call as the trade setup, okay, and the RMI. And that gives us an idea of what the market is doing. Is it consolidating? Is it correcting? Is it falling? Is it rising? So essentially, our RMI indicator has gone from giving a sell signal and coming back to zero, which basically means that the momentum on the upside is gone and the downside is not showing up because prices are still not breaking below the weekly averages. And therefore, we are coming to the conclusion that if it's not breaking it, then and the cycles are complete, then possibly the next cycle to the upside begins. So it's as simple as that. If you use classic Dow theory on weekly charts, we have already given a bullish trend reading. But of course, the RMI and momentum indicators only turn up with a lag, especially on a higher time frame. On the daily time frame, yesterday we got the positive signal on the daily RMI. So we have a lot of things one by one falling in place. And in fact, this series started with a lot of short covering post the RBI meeting. As you may have witnessed, if anybody looks at things like the total open interest of calls versus puts in the last 3 days, there was a huge covering, which is why the PCR shot up, essentially as people bought less calls and probably bought and sold more puts into the most recent advance, and that is exactly what tells you that shorts are getting squeezed. So that's my overall take on markets.
So keeping this in mind, let's move to today's first question, and it's from the intraday update that was published in India Charts. So, if Nifty finds support at the 40-hour moving average near 24,980, what would be the likely direction of the market according to the intraday update that was given in the India Charts platform?
Yeah. So I'll actually use strike, since I used that in the intraday update, and somebody actually has a question related to strike itself. So I go to the Nifty 50 chart. Okay, and now what we have really seen over here, if I go to the hourly chart, since speaking of the 40-hour average, which is up here, we've essentially seen a 4-day up move, and then we've seen this pullback. But what happens in cycle terms is that the RMI comes right back to zero, right where the momentum bottoms out. So essentially, this ends up becoming the support that we end up watching for the next up move to start, and that is what we'll have to see whether that happens tomorrow. We've come back to the support, we haven't broken it, but we actually need to see the positive momentum begin. In terms of retracement, what we've done is we've retraced around or just above 38%. I'm sorry, 38% of the rise. Now, if at all it needs to fall a little more tomorrow morning, it falls to 38%. 24,980 is the 38% retracement of the entire rise. So that is our currently considering that as the important support from, if it has to turn up from here after what is looking like just a 1-day correction. And notice you do get these 1-day pauses like here, so it could just be one of those. Then probably the uptrend should resume from tomorrow. uh, you can get more prolonged consolidations, but let's see. It's a bit early to say that. The good news is, like, here this RMI is crossed over and turned positive, which we see here. The Dow trend has not. We don't have a higher high, higher low on the daily time frame, but we do have it on the weekly time frame. So yeah, uh, the Dow trend is positive on weekly, but the RMI is not. The RMI is positive on daily, but the Dow trend is not, and those conflicts should resolve in the coming days. But my overall sense is that, yeah, we this today's fall should just be a pullback in the overall trend. So 24,980 needs to hold.
So this brings me to the second question for today. As we all know that this is a festive season going on. So considering both gold and silver have reached record highs in 2025 due to safe haven demand that we know, weaker US dollar and industrial demand for silver. So, what are the risks and benefits of investing in these metals through ETFs or mutual fund versus holding them physically, especially in the current market scenario?
So are you able to see my chart?
Uh, just a moment. No, it wasn't visible. Yeah, now it's visible.
Yeah. So yeah, that's what I thought. I couldn't see it on the screen. So now what you're looking at, let me zoom in it a bit. You're looking at the monthly chart where the RSI has really reached 81 or 91 almost. But even on the daily chart, okay, the RSI has reached, I think, around 87. Okay, this is an 87 reading. So it's getting pretty high from a historical perspective. But here's an insight. Whenever something like this happens, when you get a major move in the markets, it rarely tops out on a high RSI reading. In fact, more often than not, you will get divergences before you get a top. Okay, so it's very rare that, like here, maybe it was rare that you got a spike top. in the silver price with the RSI. And this generally I'm saying with any security, but most probably when you're at a you get a major spike because prices moved up one way like you do over here, you end up getting some kind of here you have a smaller negative divergence. So we are far from that. We've just gotten to the overbought range now. I would wait for some kind of a divergence before I even call for a near-term top in gold and silver. This is, of course, the price of silver because that's where a lot of action is happening right now. Though gold is also going up simultaneously, silver tends to move up more in percentage terms. But yeah, we are not done till we are done. So you just have to trail this move. There's no hurry to really get out here. But if your question is, do you buy here? That's a very hard thing to say. It's always nice to buy when things are consolidating, going sideways, or there is a pullback. But when it's going hyperbolic, vertically up, then existing longs you only trail. You trail so that you can maximize your gains. But making fresh purchases is always a difficult task or difficult decision. When you've missed the entry point, and where the risk reward was favorable. So even though so therefore there may be a trade, but investing is a very, very different thing. It's hard to say what the next correction will look like. We have to still judge that, when this move completes, to know whether the time to buy was right now or not. So yeah, that I think is a tougher part. But the move is not looking like it's over.
Got it. This brings me to the last question for today's session is what are the main risks investors or traders should consider before selecting small cap stocks for a 1 to 2 year investment horizon, especially in the current market scenario?
So, we are, as we are in somewhat an advanced stage of this bull market where many stocks have already moved, what you essentially look for is whether the companies that are moving, because you're mostly going to buy that what is already moving. This is not a point at where you can go and fish bottom up and, find new ideas. And if you're actually finding what is already moving, then you end up looking for growth, which means that the company has a proven history of actually growing revenue and earnings and doing it decently, which means there's some cash flow generation. Expenses are not rising as fast as revenue, so it's not that margins are collapsing at the cost of revenue. And the debt equity ratios are not too high, which means you don't have too much leverage or loans on books. It's well funded. If you've sort of looked at a couple of these broad parameters, that tells you that okay, the books will be clean, but it has to grow. So at the end, it's got to be earnings and revenue growth, because one of the valuation metrics that is become more and more common is looking at things like EV by sales or market cap by sales. And that's because revenues are being given a lot of importance over profitability. But profitability is also a good thing to have. So that's the main thing. I think when you're picking mid and small caps, we can easily look at charts and pick it up. But if we combine it with growth data, then you would be much better off.
Actually, comparing it with all the things and setting a parameter, you mean to say in that way, right?
Yeah.
That getting onto a conclusion with taking all or checking all the tick boxes so that the solution that we get is inclusive of all the scenarios. Yeah, that is a right approach, sir.
Thank you.
It's for us, sir. This is for us. We should be thankful to you. So that's all for today's question. So let's get moving with the question asked by our viewers. So the first question is from Shubham Pandya. We are seeing a compression in the FII and DII net positioning. So if we plot them together on strike, AI built not extreme, but can this trick down into a post-tariff announcement kind of move?
Yeah, I mean, the only post-tariff announcement can be that tariffs are backed off or that we get some kind of deal, and it can result in huge short covering. Okay. Market action, sometimes price action also can result in short covering. So let's see, because the shorts that we saw 2 days ago, the number was on almost 1,99,000 contracts short, whereas on Feb 28th, it was almost 2 lakh contracts short, almost a similar number. And from there, 3 days later, the market bottomed and rallied. Of course, that rally faded because the tariffs came in, but you only got a retest of those lows, and then again the markets went up. So I would think that this kind of an extreme reading is telling us that we are closer to a bottom, or maybe the bottom has passed. Uh, and any kind of news flow would definitely help.
Moving to the next question, sir. It's also from Shubham. It's a continuation of the same thing. So, yeah. From macro perspective, if I were a EM of from a relative value standpoint, Indian equities still do not seem as attractive given better opportunities available in EM spaces via MSCI dollar indices.
If we are an EM PM, EM I understand is emerging market. So what is PM?
Pre-
From a relative value
Previous market.
standpoint, Indian equities still do not seem attractive given the opportunities available in EM space via MSCI indices. I mean, sure, these are all nice contra arguments. 1 year ago, you were saying India is still the best market and other markets were less valued, and we were doing pretty well, so it was all fine. Today, we are not doing well, we are blaming the valuation. But what about
Yeah,
growth?
sorry to interrupt, sir. Uh, I PM is for portfolio manager. He is like written in the comments.
Sure. But so my question remains, what about growth? So India's growth may have slowed down, so therefore may not be comparable. But if we just accelerate it back to the 20-25% earnings growth we are getting 2 years back, okay, would it be faster than most of the other emerging markets? And in terms of size, what is the size of those markets and how much money can get allocated there? Because sometimes you can end up with a market which is not big. It can end up showing you some data points and some numbers, but it might not be big enough for you to participate. So investors usually need a big place to go with their money. In any case, I still feel India is lacking behind as far as foreign investors are concerned, more because of the long-term capital gain tax issue. It has nothing to do with India as an investment destination. So that's an important thing to keep in mind. It's not why they keep selling. They've been selling since 2015, and the market has moved up a lot since then. So do not give so much importance to how foreign investors view this anymore, because the domestic view is more important.
So moving to the next question is from DV. In current market situation, one day IP, one day down, what strategy and which features of Strike platform should one focus? Kindly guide. Thank you.
One day up and one day down. Well, market has gone up for 4 consecutive days. So what you really want to know is the trend. Like some time back, I've shown already the screen that in Strike, you look at trend readings if nothing else. I mean, I can say that sentiment indicators are the most important if you're trying to capture these tops and bottoms. If you're trying to ride the trend from top to bottom, then the momentum setup and the Dow theory, Dow trend setups are useful. So you can see the Dow trend here and you can see the RMI here. Okay, both on daily and weekly. And when you combine at least two time frames, you get a much better perspective. So here, if the Dow trend is reversed, it's positive. Even if the market falls for a week, it goes up again. And on the daily, we've just gotten a positive momentum signal. So we would actually want to track that on the way up. Now, having said that, the next thing you would do is look at sentiment indicators. Do they indicate a top or a bottom? Now, so we did get a bottom indication down here when the swing, average swing, PCR, everything, not PCR, I think, but maybe some other things got really low and gave you a bottom signal. PCR was low down here. So here it was just not the swing, average swing, but also PCR, AD ratios, everything was oversold. So the use of all these ratios, what I'm talking about, are on the left hand side here. The open interest put call ratio, which is the PCR. Where is it? And then how are participants positioned? FIs, for example. Now somebody mentioned that, you know, what about this? And I'm like, this is where they are. They were very short here, and now they're very short here. And they were very quite short here. And remember that they move pretty fast. So moment it went up here, prices have turned, but they've shorted. But if you're trying to get the big picture is that if you're down here, it's an extreme. It's eventually going to cause this. And when that happens, this will go straight up. But again, that doesn't answer the problem of cash market FII flows. So FII flows into cash market will depend on something very different, possibly capital gains tax. But in the futures market, even if they are hedging, if everybody decides to hedge, and that's the herding that we are really trying to capture here, if everybody is trying to do something, then possibly that direction is not the trend. Okay, we are not saying you're wrong in trying to do something. It could be if it is working for you, why should it be considered wrong? But what we want to capture is and understand is the turning point. What bias should I have? And if everybody is on one side of the trade, which in this case are the hedgers, then I want to be on the other side of the trade. And all I have to do is fine tune the short term. So I think RMI and sentiment are unique because they are proprietary indicators of ours, and that is possibly why we think so, and we promote it accordingly. Have you frozen, or image seems to have frozen?
Yeah. Sorry for the inconvenience. A regular problem with the network issue. So moving to the next question is again from Atul. So how
How
would
do you
you
measure
interpret?
the sectors
Sorry.
in strength now, looking at heat maps from 7th April low for long term, or we look at RRG? See, each one has a different role. RRG is measuring the continuous change. Of course, you can go to a weekly or monthly RRG to look at the sector rotation. Which of them are showing that the indicators are moving from left to right on top. So how would you interpret sector strength? See, not just the heat map, but what I actually do is look for relative strength. Okay, so in the heat map, for doing that, I created something known as the custom heat map, which allows you to look at relative strength within a certain period, and that period has to be from a top or a bottom. So when you say 7th of April, we are probably seeing from here way back. Okay, but I should either measure from down here to up here, or I should measure from up here to down here. Now that the market is trying to rise, I should look at what did it do when we were falling. What were the best performing sectors when the market was down and dusted? So let us take it even from this peak, which is 30th of June, okay, till even the recent low, or maybe this low,
So
30th of
if you're
30th of
showing, sorry to interrupt, sir. Sorry to interrupt,
screen.
but if you're showing something, your screen is not visible.
Yeah.
Yeah, now it's visible.
So this is the Nifty chart, and I'm trying to say is that let me measure from this top, maybe to this bottom, or we can try and measure later this to this. So this is 30th of June to 30th of 29th of August. Now, how is that useful? I put those days over here. 30th of June, 29th of August. Sorry. What happened? So now you're looking at the performance of sectors based on the time period chosen. Now, which is the top performing sector? It's actually the auto sector. Okay. And so this was sort of an early indication that this is the segment that is going to do well. I'm sure it's not picked up in the last 2 3 days, but uh, at that time, if you bought it at the end of August, you would have done pretty well. Now, FMCG is also there, but being a defensive sector, I would sort of ignore that a little bit. And I'll go on to the next, and there's something on the manufacturing and then metals. Now, let us take a slightly different period as well. So, if we take 2 3 different periods, then you'll find that there are some common segments showing up. Say, for example, even if we take from here, 18th of September to 30th of September. Now we're looking at PSU banks, metals, oil and gas, commodities. Okay, so slightly different mix, but metal seems to be common. Of course, it came in a later number. Auto seems to have gone down the list in the recent fall, and we're actually seeing financials coming up. Now, I've done this exercise before also on a couple of different time frames, and I found financials, basically PSU banks, private banks, metals, commodities, these basically showing up on top, and autos. Okay, so I think I've started to believe those are the sectors that will possibly do well in the months or weeks ahead. Now we can again get into an argument on, okay, but is that happening now from say the 26th of September? So we can even go on the way up on the heat map. We can take it from 26th of September and to date and see how we're actually doing. So what is actually doing well as the market is advancing higher. Now you might see IT on top, and I can say that IT I don't really like so much, but we still have PSU banks, financials, okay, followed by mid caps, and somewhere down here oil and gas and metals, which is oil and gas is again the commodity space. So that's where I think financials which have picked up recently, and financials are the ones that picked up even in the initial rally when we started in April before this correction. So I think it's very clear that financials will be leading the way uh, in the next leg up as well. Okay, it can get followed by a couple of others which we are getting in these different scans, which includes metals, mid caps, small caps, uh, autos, oil and gas. But yeah, that's the lot to really keep your eye on from a sector perspective. Now he's also asking me, okay, what if we actually get into RRG? Now, RRG, if you're trying to take a bigger time frame, I would then go to weekly. And when you're looking at weekly, you look for segments that are going up in a particular way. A particular way means that they should be rising from the left hand side to the right hand side. Okay, somewhat upward slanting from this side to this side. So you see that a bit in the auto sector here. You see, even though autos may not have recently gone up on the weekly chart, they have been rising from left to right. And that's a good sign, except that autos have gone very far on the leading side. So sometimes in the near term, they can rotate back just to complete a cycle and then start performing again. So but you have something here which is coming up, this PSU banks, right, slowly coming up from behind is the PSU bank index and moving upwards. You have another one here which is doing that, which is the Nifty India Manufacturing Index. So on RRG also you can get, and again you have PSU banks down here. You see Nifty PSU bank, which is moving up from down to up. So even though it's moving from weakening to leading, we consider it good, because when it is moving up in this particular angle, which is uh, 45 degrees to the right hand side, it shows both momentum and relative strength expanding. So it's really the angle at which this is moving that makes it interesting, rather than just the quadrant where it is. I hope that gives you some insights, especially to people who are not users of RRG, how visually you can actually spot sectors that are doing well over a period of time, and then choose accordingly.
So moving to the last question, second last question, because today there are many questions. So moving to the second last question for today's live is from Mahesh. FIIs have been maintaining extreme long positions for over 2 months now, similar to the positioning seen at the beginning of the year. Does this indicate a new normal in their position behavior?
FIs have been maintaining extreme long, they're short.
I think so. There has been a typo error.
You may have meant DIs. So DIs are extremely long, not as often as FIs are short. Only when there's a meaningful turning point, important turning point, there you do find DIs having a large long position, and they have been buying over the last couple of weeks in the index futures. So that does make them pretty long on a relative historical basis. I don't see any questions from X though. Again, I mean, I've noticed this so many times. I don't know it's by chance
And
or
and the viewership on the X is the highest that we are getting. So
yeah.
people
So
who are watching from X, you guys can also comment down your questions, and we are here to answer your questions. So moving to the next question. Is Nifty making a triangle in wave two?
I don't think so. I don't think it's a triangle. It's a complex pattern. The visual may look like a triangle. Okay, so sometimes a complex pattern which is contracting in nature can visually end up giving a triangular look, but we just mark it as WXY. So I don't think it's a proper triangle.
So the last question for today. Hello, sir. Can we say that new impulse of fifth wave has been started in gold and BTC on daily time frame? Any specific reason why gold is rising continuously? Can we accept ABC correction soon?
New impulse of fifth wave has started in gold and BTC. New impulse of fifth. What does that mean? Gold, I mean, I already explained gold in the beginning, so I hope Sagar you saw that. Do revisit what I said about it with charts, but I'll just mention that yeah, we are in the fifth, but the fifth is subdividing, and so, and I don't know if you're talking about fifth. At, well, it can't be at a yearly degree, so it can only be quarterly, monthly chart. We could be in a fifth of some degree, but I'm not sure the gold bull run ends, and therefore I don't think this is the end of what started in 2015. I'm a little skeptical of taking that stance. So even if there is a correction, eventually you will get to a new bottom. I don't think it will be a severe 1980 type event. I don't think we have reached that point.
Mm. So that's a wrap up for today, sir. We are done with the questions. So thank you everyone for joining. Thank you, sir, for your time, for your answer, the time for answering the questions and clearing all the doubts. And it was a great session. And thank you everyone for joining. Trade smart, trade safe. Till then, meet you in the next session on Friday, same time. Thank you, everyone. Thank you, sir.
Thank you.